correct the boy's name.
Hello, good evening, Katherine. How are you?
Yeah, I'm good. How are you, Prue?
Very well, thank you. Thank you so much for making time for our lovely Q&A on I Love Property. Very,
Thank you.
very warm welcome to you. And it was
Appreciate
great
it.
to run
Happy.
into you the other day as well. Yeah.
Yeah.
Happy Monday. I just realized it's Monday already, and it's already end of March as well.
Oh, I
It's
know.
quarter of
Don't
the year
remind
gone.
me.
Hmm.
Easter's already here. Goodness.
Thank you. So, Catherine, for all the viewers who are going to be listening to the session now or later on, it is a privilege to host Katherine Loke, who is a dear friend, and of course, she runs a successful finance mortgage business. So, to open up the conversation, I always love to know a little bit more about you so that people who are listening in that connect to you. So, of course, I am Puru. I am partner in Find My Real Estate and the host to this podcast slash Q&A for today. So, Catherine, tell me a bit about you. Very
Oh,
keen your journey as an individual and then as a professional, and how did FinWab broking business happen to you? Over to
yeah.
you.
Thank you. Oh, goodness. It's been quite a journey for me. I started my personal journey probably when I was 21, and I purchased my very first investment property. It was an off the plan apartment in the western suburbs, Williams
Oh, really?
Landing. Yep.
Hmm. I can see
Um,
it probably from here.
yeah,
I'm in Point
because
Break.
you're that
Yeah,
side, aren't you?
yeah.
Um, and so that was my very first taste. At that time, I'd been a property manager already for a few years. So I absolutely loved going through the final inspection and picking the things that were wrong in the build. As I'm sure you know, off the plan, that sometimes doesn't always go to plan. Um, but from there, my husband and I purchased a couple more properties throughout the years. I was in real estate for many of those, also moved into the accounts department at Ray White and got
Okay.
to see, yeah, on that side of managing the accounts, paying the commissions to sales agents. I thought that was really interesting just to have another view. And I also worked at one of the big banks as a mortgage specialist for a few years. And during the Royal Commission, actually, I moved over when my team was made redundant, and I went into the complaints department, which
Okay.
I'm sure you could probably guess how that went during the Royal Commission as a complaints officer. But it kind of gave me a really good holistic view of property everywhere from how to get a mortgage and helping clients, being a property manager and managing investment portfolios for other landlords and managing the accounts as well as doing it myself. And so I wanted to do something different. I loved the idea of being self-employed, and I came across brokering and I was like, amazing, this perfect for me. And I being self-employed, you are, kind of lonely sometimes. So
Yeah.
when I was looking for a mentor, an office to work in, I wanted somewhere close to home as well within the southeast. And that's how I came across FinWeb. So they're an Australian-wide brokerage, so the amount of support I have is incredible. But I've also got access to admin team and office in the southeast. It's in Cranbourne West. And it's kind of just nice to be around other brokers and, support each other, bounce ideas, and hear about, what kind of loans and, lenders that they've dealt with recently. So that's kind of a little overview of, kind of my journey over the past 11 years so far.
I'm Little is a understatement for sure. The amount of work you have done, it's incredible considering you have done real estate, property management, and then you have seen a lot of selling of the properties, management of the properties, and then transition to a bank specialist, which is an incredible experience, I'm sure. And then you're
Mm.
doing your own thing. Well done. Big pat on your back.
Thank
And
you. It's very different coming from corporate
yes.
to working in my office at home.
And you mentioned about buying an apartment in Williams Landing. That's quite brave, really. And I'm picking on the age which you mentioned, 21 years of age. So people who are listening and can get inspired, it's amazing. So how did that go?
I overall had a good experience
Yeah,
of it. I personally loved purchasing off the plan because I was able to find which apartment in the building I wanted and pay just a very small upfront fee to hold it. And then
yeah,
I didn't actually have to get the loan until completion. So that was, for me, it helped me see the clear picture of, okay, this is how much I'm going to need. This
yeah,
is how I'm going to need to save and make sure I'm prepared. So, the financing goes nice and smoothly. And I actually ended up living in the apartment for 2 years as well, just before COVID hit. So it was kind of nice to buy it as an investor, move into it myself, and rent it out again, and enjoy the property, which a lot of investors don't get to do.
yes, absolutely. And I always say that the best time to buy property, and it's a famous line in real estate, anyways, was yesterday, and next one is now. So you have started your journey early, and it doesn't needs to be perfect. It needs to start.
Mm.
And then
And
you, yeah, go ahead.
I was going to say as well, like, I think I came across the ad just on Facebook, or it came across socials somehow, because I was the very first one out of all of my friends that,
Hmm.
at that time, being so young, buying property isn't usually the first thing on someone's mind.
Hmm.
Um, and my parents didn't have investment properties. They had a holiday house. So, like, I kind of already knew that, oh, it's nice to have more than one property.
Yeah.
Um, so, yeah, it was kind of a lonely journey, but I absolutely loved experiencing it and then being able to share it with my friends. And they've now been able to, do similar.
Well done. And I would be keen to know some examples of your case studies of how you would have played with the debt opportunities for the remainder of the properties, which I gathered another two or three you added. So that's incredible.
Yeah.
Considering you mentioned 2021 was the first purchase, we are only talking 4 years ago, right?
Oh, no, so when I was 21, so 11
Hmm.
years ago now,
All
was
right, all right.
yeah.
So I correct myself, but it's still pretty good. What it means is every second, third year you were adding another property to the whole portfolio.
Yeah, correct. And we were really big on making sure that we saved as much money on the purchase. So
Mm-hmm.
every single purchase we did, we made sure it was below 80% LVR, so we
Mm-hmm.
didn't have to pay lenders mortgage insurance. And
Mm-hmm.
we also kept them all separate. So the securities were all separate, and that they, one loan, one security, one loan, one security. None of them were cross collateralized, because at that stage we knew that we wanted to buy more property.
Yep.
So we didn't want them to be tied down, and also to have the ability to refinance if we needed to. We just wanted it as simple and straightforward as possible. And back then, like, the property prices have really grown. Like, I bought in Frankston, and I think that property was maybe 7 years ago now. Got it
Mm-hmm.
for, I think it was 540. There's like hardly any properties in Frankston that are around that price now, and that property has gone up so much. Like, we're looking at maybe selling it in the next 5 years, or I don't know, maybe I'll bulldoze and develop on it, 2 townhouses, see how I'm feeling.
Well, you're
But
not stopping. You're not stopping for sure. I can see that already. You're just going to keep on doing it. All right.
exactly.
With that, I guess it's a good segue to our topic for the evening, which is uh, debt planning for investment structuring. Right. That's structuring for investment planning. Really. So
Yes.
so many things come to me because I do this day in day out, and with a lot of brokers who are important to the whole buying process in a property. The whole value chain of the investment transaction starts from brokers. So would love to understand from you the terms, which can be a little bit complex for someone doing for the first time. And in my mind, generally there are people who are buying for the first time. It can be
Mhm.
their own home or an investment based on their choice. Then people who have done some of the properties, and then there are people who have done a lot of these things. And then again, there are more variation of what they're buying: residential, commercial, acreages, and
Mm.
more complex things like joint ventures and all that. So when you say debt structuring, what does it really mean for a
Yeah.
layman to understand?
Yeah. So the easiest way probably to talk about what debt structuring is how we're setting up the loan.
Okay.
That's fundamentally what it is. But to be able to get to that point, we need to know what your goals are, because that's going to determine where we go from there. Are you just wanting one investment property? Are you wanting multiple investment properties? Are you a first home buyer and that's all you've got? And so you're wanting to get your first investment property on top of your owner occupied property. That's what will be controlling how we're setting the loans up. So for somebody who, a lot of the cases, they're a first home buyer, they buy their owner occupied property, so they can take advantage of the first home buyers grants and the schemes. They've held on to the property for a couple of years and they've been able to grow some equity. And they're like, I would like to get into property investing. But it's hard sometimes to be able to save a good enough deposit.
Absolutely.
Sometimes the property market will go a little bit better than what you're able to save. So why not use your equity in the property? Now, I always recommend, if you're wanting to save yourself the most money, try to keep your owner occupied property at 80% so you don't have to pay lender's mortgage insurance again. But if, you can't, well, we've got that option there, and a lot of lenders will still lend to 95. But so we'll take the equity out of the property, and that's what we're going to use for your deposit. If you've got 200,000 in equity, we can use that to help
Mhm.
fund your second property. So, even though your next property will still be at 80% because we'll use the deposit to bridge the 20%,
Yep.
you're technically still lending 100%, which
Yes.
is good for tax benefits.
Yeah.
Because if you think about somebody saving $200,000 and they've just got it sitting in their savings account, and they go, I've got a property, but I don't want to use the equity, so I'm just going to use my savings as the deposit for my investment property. You're not getting any tax benefits on that savings that you've got. It's just you've put it into the property as the deposit, and you're only getting the tax benefits on the loan amount. But if you take the equity out, you're getting tax benefits on that as well. So the entire amount of the investment property, you're getting tax benefits. And when I'm talking about tax benefits, that comes down to like negatively gearing. Usually for the first couple of investment properties, people get their negatively geared, which means that the costs of the property are
Yep.
more than the income of the property. And then that difference is offsetted on your income for how much tax you've got to pay. And then that's why people get money back at tax time, which is like forced savings in a way. I absolutely love it. I'm like, oh, there's another chunk of of a loan that I can help pay down from a mortgage. And
Okay.
so then there's other people, the more experienced people, they potentially can cross collateralize. So I had a client recently, and they have their owner occupied, and then they also had one investment property, and they wanted to take advantage of the lower interest rates some other lenders had. But in Melbourne, we've had a little bit of a decrease in property values, and their owner occupied property had decreased quite significantly. Even though we got a second walkthrough valuation, we had to cross collateralize both of the properties so we could stay under 80% LVR. So they didn't have to pay lender's mortgage insurance. So we refinanced both of the loans to the one lender, and we were able to get pricing. So if you keep it under 80%, we can get a pricing discount a lot of the time for them. So even more savings. That specific couple weren't wanting to buy in the future. So the issue of cross-collateralizing wasn't even an issue. Like, it was perfect for them because they don't want to buy another one. But if somebody did want to use their equity and buy a second investment or a third investment, that's when it can get a little bit messy. You've either got to keep it all with the same lender, or you've got to try to separate the securities, and it can be a little bit more time consuming. Yep. And then the third one would be people that have investment properties and they may have maxed out what their personal income can service. And then they start looking at self-managed super funds, because you just use your super contributions and the rental income to pay for that. So it's completely separate from your income if you're PAYG, or even self-employed and paying yourself a super contribution. We can do that separately, and they can buy another residential, commercial, heaps of things you can do with an SMSF.
Yes, and it's getting very popular. Of course, it's a highly compliant product, and I'm sure you work with your disclaimers and everything in place. But,
yes.
but it's so important that this information goes out to people, so at least they know about whatever these terms are, how people are really building up their wealth, their first homes, their investments, and all that. So many questions come to me as I listen to you, because I'm trying to keep things in more layman language for people who may not be able to understand everything. So when we serve clients, and I'm sure these are the same clients who come to you first, that if I am a permanent job person versus I am a contracting to a company, so I work on a daily rate or a fixed term, I give them my invoice, versus I run my own business. There are different type of complexities which might be there for a broker to serve, correct? So what is your guidance to people in these three different buckets? Because one of the things I've noticed is people come very late to plan their loans as well, because they just get inspired by someone or they listen to something. But if it allows, and if they have a 6 to 12 months outlook for doing these things, what would you suggest to these people?
Yeah, and it's exactly the point. Hindsight is a beautiful thing. And I always tell people, if you think it's something that you're going to want to look at doing, even if it's, say, 2 years, speak to a broker, speak to your accountant. There are different kinds of loans that we can get. Say you don't have your financials, like you're running a business and you haven't done the last year's financials, but you've done the year before. There are still options for us to be able to get you a loan and meet your financial needs. But the thing is, with less documentation, the higher the interest rate. There's certain lenders that will accept contracts, such as I had a customer recently who only had 5 months left on his contract, and it wasn't a reoccurring role. And I had to find a specific lender that would accept a contracted employee with only 5 months left, because a lot of them all want 6 months. So there's a lot of workarounds, but getting the advice and knowing where you are, and if you want the best interest rate possible, what you need to do to, put yourself in the best situation. When it comes to residential lending, it's, all about risk. The bank's going to lend you money. Even the second or third tier lenders, they will take on more risk, but you're going to have to pay for it. And it's making sure that you are happy with those risks. And if you're not, speak to your financial planner, who can, point you in the right direction. If you're thinking of a self-managed super fund, speak to your accountant. If you're self-employed and have a company, speak to your broker. If you're PAYG and you have no idea and you've just started in a brand new industry and you want to buy a property tomorrow, and it's like, let me put you in the right direction. We might have to wait until your probationary period's up. But there's also lenders that don't require that. So there's a lot of workarounds, but knowing what you want and to put yourself in the best possible position, speak with a specialist.
Absolutely. And hindsight, as the word is, it's such a powerful word. All right. And there's a question, what is a debt splitting? Because I've heard about this earlier as well, like in the same loan, you can split it in different ways. So if you can help the listeners understand that.
So debt splitting is basically having one loan and you can split it in half. You can split it in three sometimes, depending on what you're wanting. People do that for a number of reasons. One might be they're not 100% sure on the variable interest rate. It's very questionable when the next drop is going to be. And so they're leaning more towards fixed, but they're still on the fence. So they go split. Okay, I will split 50% and do it fixed. So I know exactly what the repayments are, at least on 50% of my loan. And then the other 50% is going to be variable. So if rates do drop, I haven't missed out totally. I'm still benefiting on 50% of my loan if variable rates drop. And you can always refinance them and join them together. I had a question recently from someone that they thought, okay, well, if I got one loan and then split it, is it the same serviceability? Yes, because it's on the total amount of the loan, not just, one split here, one split there. It's total amount. We'd take into consideration, obviously, can you afford the interest rate on the fixed portion and the interest rate on the variable portion? But yeah, it's the total amount, and it's depending on, what you're wanting to do with that property, if you feel secure within the market or not.
Okay, thank you. It is a good explanation. Another question we have is, what is tier 1, tier 2, tier 3 lending? This is a term probably someone would have heard somewhere.
So tier 1 is the big banks: NAB, ANZ, Westpac, Commonwealth. The lenders that that are in the news, that have been around for forever, they're tier 1. Tier 2 will be the next level down. So the specialist banks, Macquarie is technically thought of as the 5th major, but they've been usually within the 2nd tier. And then 3rd tier involves private lenders. So they use their private funds. They usually have higher risk appetite. They're willing to do what the big banks won't do. Some will have really good competitive rates because they specialize in certain areas, such as foreign income, certain postcodes that big banks don't want to lend to, such as dense living. A lot of big banks don't particularly like dense living within the city because the apartment sizes are quite small.
Yep.
And as well as commercial lending, land and whatnot. So there's different levels because of the popularity and how long they've also been around. You know, some of the private lenders may have only been around for the past 20 years, but Commonwealth, they're like the first bank ever, for us to use. They've been around forever, longer than I've been alive. So, that's also another thing that
So
plays
it's
a
the
part.
market presence is the tiering structure for the lenders in that sense, the amount of
Yeah.
loan they give or the amount of presence they have, right?
Yes, in a lot of cases, though you'll still find some of the second and third tier lenders holding a larger percentage of certain specialized lending that the bigger banks aren't as competitive on, but
Gotcha. I'm with you now. Yeah.
they mainly hold most of the market share.
Okay. Excellent. And what are low doc loans?
Yeah. So low doc loans are an option where, like I mentioned earlier, if somebody hasn't gotten their finances together, they might be, maybe they've got some defaults, their credit history isn't as
Okay.
squeaky clean as what it could be.
Okay.
Low doc loans are good for when you don't have all the documentation, something's missing.
Okay.
Maybe you've only got an accountant's letter to support
Okay.
your income. They're an option that some lenders will allow. Second and third tier lenders, they're less common when it comes to the big banks. They usually come with a higher interest rate because the lender is getting less documentation from you to support your financial situation, your
Yep.
company, your business. Maybe you're a tradie and you used to work as a tradie, PAYG, but now you're self-employed. You've got a
Yep.
similar industry, but we've got no track record of how you run a business. You may have only been trading for 1 year and don't have the necessary documentation. So we'd have to go for a low doc option, but it comes with a higher interest rate usually.
Makes sense. So it's basically they are taking risk on giving you the loan when the normal banks probably wouldn't take the risk. And in lieu of that, they might have a bit more different type of requirement to give the loan, and also they charge you a little bit higher than the normal interest rates, right?
Yeah. And there's even lenders out there that do no documentation. There's
Okay.
such a thing as alt doc as well. So maybe you've got all your financials except for one thing that the lender wants. So,
Okay.
you'll have slightly higher interest rates, still not as high as a low doc because you
Yep.
can still provide more documentation.
Yep.
So, they're really good for self-employed, commercial. You see a lot of them being used, for businesses and companies.
Okay. And last one, what's a lease doc loan then?
Lease stock loan, I haven't done too many of them. Puri,
Okay.
you've kind of hit me with one.
No,
There
that's
are,
fine. It's a question which was coming through, and I know a little bit, but I thought maybe I'll ask you as well.
yeah, I haven't done one in a while. They're less common.
Okay.
So yeah, I probably won't want to give advice at the moment because I
No
don't want to
problem.
give anything wrong advice.
No worries at
Feel
all.
free to shoot and answer that one for us.
One of the viewers who knows that maybe they can post it. Thank you. So in terms of the structure of the loan, I get it. Now, when a person is buying in their own name versus a family trust or a self-managed super fund, I understand there are different taxation entities as well. So if you
Mm,
want to share your experience and
yeah.
suggestion about considerations when people are in those categories, what they should be considering or what you've
Yeah.
seen.
So first and foremost, I would always say speak with your accountant. Their accountants are the ones legally allowed to give advice around the taxation side of things. As a broker, obviously, I come across things and I've got the general knowledge and I've seen what I have seen, but I can't give advice when it comes to taxation side.
Fair enough. Yep.
With SMSF, it's very different to if it was just in your individual name or a family trust. With SMSFs, you've got the SMSF, you've got the Bear Trust, and then you've got the property. That's actually a really good structure in terms of that you're able to protect yourself against bankruptcy. So if you as an individual went bankrupt, the property is protected, the asset's protected. And you're able to, like I said earlier, if you've maxed out in your personal income, you can still purchase within an SMSF with your super contributions, and the ability to control the investment is a lot higher when it's in an SMSF. When it comes to obviously having trusts and an SMSF, there are fees involved. You've got to pay the accountant to manage it. You've got to pay to set it up and the running costs of it. And that's also included in the serviceability. So your super and the rental income of the SMSF has to be able to pay for all the fees, the annual fees, in the SMSF as well as the trust. When it comes to just individual and you're buying in your normal name, obviously we spoke about that earlier. So you can have positively gearing, negatively gearing. That's in terms of the tax benefits you're getting from the investment property. Is the property costing you more than what it's bringing in? Well, then you're going to be getting potentially some tax benefits there. If it's positively geared and it's making more money than it's costing you, in a way it can still be negative, because that could then bump you up into a higher tax bracket and you've got to pay more tax. So you've got to speak to your accountant about what specifically tax-wise is beneficial for you, so you're advised correctly.
Okay. No, thank you. It's very insightful. What are the top trends you are noticing for this year? So far, it's already 3 months gone, and the one interest rate down. How are you seeing it for your business?
Yeah. First home buyers. It's, a buyer's market at the moment, with prices in Melbourne being quite stagnant. Even though interest rates, we had one rate cut, it did kind of ease people's tensions, but we haven't seen much move. There's still really good property prices out there for first home buyers, and they're able to take advantage of the government schemes as well. And SMSF, like you mentioned earlier, they're very popular for the investors that are quite seasoned and they're wanting to think more about their retirement strategy, how they're going to be paying off their debt when they're reaching retirement age, to be able to take advantage of the SMSF and the investment in there. I should also mention, I know we're property people, but with SMSFs, once you speak to your financial advisor, there's other ways that you can invest in an SMSF, not just property as well. And that's actually quite big. Last year, there was some results that were published that for SMSFs being one of the most popular ways of investing, shares and bonds were very popular, and commercial property was the third most common investment within an SMSF. So there's some really good tax benefits for commercial properties, especially if you've got a business yourself and you buy a commercial property with an SMSF, you can then lease it back to yourself and have even more tax benefits. So commercial property, has been quite strong in that area as well.
Wonderful. And one thing I want to touch point on, which we spoke about earlier when I met you. So based on different professions as well in Australia, there are different type of debt products and debt structurings, I guess, which are
Mhm.
possible. And for sure, you specialize in certain professions and their debts. So if you want to talk about that as well for the viewers, it will be a good prompt for them to
Yeah.
maybe they are one of them and they just haven't realized that.
Yeah, so with residential lending, I specialize within emergency services, so essential workers. I got into that mainly because my husband is a police officer, he's a detective. And if you know anyone that is in the essential services, there's a lot on their pay slips sometimes, the amount of salary sacrificing that there is, and different kinds of pay, leave entitlements, it can be quite messy. And sometimes even the lenders aren't experienced in reading the pay slips as well. So you
Okay.
need a broker that really understands their pay structure, especially with police, with the new EBA. I'm getting a lot of police officers coming asking, okay, well, this year I've got another 3 pay rises. Should I look now? Should I look at the end of the year? What's the difference in my borrowing capacity?
Yep.
I'm very across all of that because it personally affects us as well. So I really love working with them. There's lenders that have specific policies that support our essential services. So, there's lenders mortgage insurance waivers. They can lend up to 90% without having to pay LMI, which is a huge savings. There's also, cashbacks. There's better interest rates sometimes. And knowing all of that helps put the borrower in the best financial position possible,
Okay.
because it could mean like a decline or an approved, knowing that information. So, anyone out there, if you know an essential worker, even a nurse, not just an ambulance driver or paramedic, I can help them there.
Excellent. So essential workers are people who are in police services, both
Police,
federal, state.
fireys. Yep, fireys. It also involves medical professions as well. There's special policies for pharmacists, nurses, anyone that works in a hospital as well. They don't have to be frontline workers. So the list is actually quite long. So if you think that you might be an essential worker, or you
Yeah.
just want to know if there are any special policies out there that allows you to borrow more without paying lenders mortgage insurance, or your pay slips are a little bit convoluted,
Mhm.
hit me up.
Well, thank you. It's very insightful. And one question I have is why is it so that they get this special product suit for their
Mm,
loans as compared to other professions? I guess that's a natural question which comes to my mind.
yeah. Well, look, there are a couple of policies out there that support, lawyers when it comes to lending. It's unfortunately not the same with, necessarily blue collar, that tradies, they do a lot for our, community. But the essential services, the government and the lenders have decided to put an extra step forward to, say thank you in a way,
Okay.
to recognize the work that they do, the studying that they've had to do, the risk that they take with their jobs.
Hmm.
Um, and they understand that, our society just wouldn't work and function without them. So they've got additional policies to assist them with lending and make sure that they've been looked after.
Okay.
With other professions as well, first home buyers, we've still got options to, get you 95% lending without paying lender's mortgage insurance if you're a first home buyer. So there's still other ways around it that we can find a good option for you to save as much money as possible. But with essential workers, they're lucky, I suppose.
No, thank you. It gives a lot of context to the whole conversation. And absolutely, I agree with you that there is a lot which goes in their jobs, which they do as compared to a lot of other professions. So it's absolutely that. And maybe the professional demand of their work is so high, it becomes a lower risk component from a job stability perspective as well. I mean, financially speaking.
Yeah, the turnover, is a lot less, I hear, in those industries. And like you said, the job security is there. It's quite hard to get fired within some of those professions. And the pay is very stable. And there's, the pay rises every single year. They've got the EBAs, like I mentioned. So the banks know that the pay is, no matter what, going to go up, each year. So they've got the security there, knowing that, yes, we've got the serviceability here, but it's going to increase, and the potential of them being able to pay off their loans faster as well is a high possibility.
Excellent. Is Defense Forces also part of essential services, or they are treated separately?
They're separate. There's specific lenders for defence families, and I'm happy to speak to anyone about that.
Okay, no, excellent. Thank you. I guess the time's going very fast. It's already close to 45 minutes. And what I would love to know in the last few minutes, of course, it will be great to know where you're located. I think you mentioned Cranbourne East or West?
West, yeah. Cranbourne West. Yeah.
And
so
go ahead.
I'm in Rowville. Obviously, as brokers, we're very mobile. So I do specialise in the areas of the southeast, but I'm happy to work all over Melbourne. I have actually lived in every side of the city. I grew up in Dingley, lived in Mulgrave, lived in Coburg, lived in Williams Landing, and now I'm back in the southeast again.
So you're proper Melburnian in that sense. You crossed the river quite a lot.
Well-travelled Melburnian.
The good coffee spots in all these areas, which we boast a lot about. If you Sydney siders are listening, you should remember again, Melbourne coffee is the best.
Exactly.
All right. Yeah. So because you're in Cranbourne, it's a very good growth pocket as well within Melbourne Metro, Greater Melbourne. It will be, and I am getting a lot of calls. Melbourne is hot on the heels in terms of first home buyers, and also investors. So directly from someone who lives in that area, what's the movement looking like from the growth corridor where you are in southeastern part of Melbourne? Yeah,
most definitely the two suburbs that pop into mind are Clyde North and Officer. So, there's heaps of work being done in those two suburbs. Officer has a couple of new developments, some school upgrades as well. They've got some great hills with, property views and new developments going there. And I've had a lot of clients looking in that area. It's got close to transport as well, and it's right there near the freeway, so direct line to the city for anyone that's needing access. Clyde North, there's been some issues previously with some of the roads. When they first develop suburbs, there's usually just one lane roads. They've just recently advised that they're redoing the roads and widening the roads there to really help give some relief to the residents. And brand new housing estates in Clyde North with new shopping centres and facilities. It's close to transport as well, and it's a very populated area when it comes to job opportunities some really great schools out that way as well. A lot of
Okay.
people are moving to the, southeast for communities as well. So Clyde North is definitely an area to keep your eye out. I have personally driven the streets in Clyde North, and there are some beautiful houses out there. I am dying. I go there and take photos of what I want my dream property to look like. So if you're looking in the market, have a look at some of the display homes out in Clyde North. They're amazing.
Excellent, excellent. And thank you so much for sharing the time with us and the viewers. It is insightful. You share your experience. It definitely comes across quite clearly. Um, this video will be posted back on the group and a lot of other digital groups where we are allowed to post content, and also on our on all the Find My Real Estate digital handles. We will post your details of contact under the comment section on I Love Property group as well. So all the viewers, if you are looking for a good discussion regarding debt structuring, if you have a hindsight of doing investments, if you want to listen to some success stories of investment from Katherine, please ping her. It was a privilege talking to you, Katherine.
Yes,
And
thank you. I've thoroughly enjoyed this interview and chat. It's been great to explore all the areas. Hopefully it came across my how passionate I am about investment properties. I've done it myself, and I just want other people to be able to experience what properties can do for you, especially for early retirement and setting yourself up financially so you don't have to work until you're 75.
I guess I don't mind working till 75, but I don't have to worry about earning money
Yes,
in next 5 years or so. That will be good to say.
exactly. Work because you love it, not because you have to.
Absolutely, that's true. All right. Thank you so much, Katherine. You have a lovely evening.
Thank you, everyone. You too. Great chatting.
Bye bye.